You probably know 7 & I Holdings, right? The global giant behind all those 7-Eleven stores you see everywhere.
Absolutely, a household name.
Well, they're doing a lot more than just, selling snacks these days. They're right in the middle of this massive transformation. It's kind of a seismic shift for their whole business.
It really is.
So today, we're going to take a deep dive into their latest financial results. This is for the fiscal year that ended February 28, 2025.
And we're going to uncover some of these really bold, strategic moves they're making. Moves that are basically redefining what convenience even means for a company like this.
Exactly. Our mission here really is to cut through all the complexity you find in those official financial reports
Yeah, they can be dense.
and just pull out the most crucial insights for you. We'll look at everything from their overall financial performance.
These huge decisions like selling off major parts of their business.
Right, and even planning an IPO for their North American operations. Big stuff.
Huge. And we'll touch on some perhaps surprising details too about, how they run things day to day, their operational efficiency, and what they're doing on sustainability.
Think of this as your shortcut, your way to really get a handle on how a company this massive is, well, radically transforming itself.
Let's get right into it then.
Okay, so let's start, maybe zoom out first. Look at the big picture, their overall financial health and these huge strategic shifts we mentioned.
Sounds good.
So on the surface, the revenue numbers, for the fiscal year that just ended, they actually look pretty decent.
Right. Their total revenues from operations climbed up to nearly 12 trillion yen.
Which is what, roughly 80 billion US dollars, something like that?
Yeah, about that. And it's up 4.4% compared to the previous year.
So sounds like growth, right? But maybe it's not quite that simple.
Well, it does sound like growth, but here's where the plot kind of thickens.
Okay.
While those revenues went up, their operating income, it actually plummeted, down over 21%.
Wow, 21%.
Yeah, down to about 421 billion yen. And their net profit, the bottom line for shareholders, dropped even more, down 23%, down to just over 173 billion yen. So, this isn't just some minor dip.
No, clearly not.
It really highlights a critical challenge, I think, for these big, mature retail giants. How do you stay profitable when your costs are rising and the competition is just intense?
A trend we're seeing everywhere in brick and mortar retail, really.
Exactly.
And that sharp decline in profitability, even though revenue grew, I mean, that really underscores why they're making such radical changes, doesn't it?
Absolutely, it puts the pressure on.
Yeah.
So, given these financial pressures, what's the biggest strategic shift we're seeing them actually make right now?
What's the game plan?
Well, it feels like a high-stakes bet, really, to secure that long-term future. They're making this really dramatic strategic pivot,
Okay.
focusing almost entirely on their global convenience store business. That seems to be the core now.
So what does that mean in practice?
It means selling stuff off. They've formally agreed to sell their entire superstore business group.
The whole thing.
Yeah, well, that includes names you might know like Ito Yokado, Shell Garden, basically all their department store and food supermarket businesses,
Wow. Who are they selling to?
to Bain Capital. And this divestment, it's massive. Estimated value is around 814.7 billion yen.
Which you said earlier was about 5.37 billion US dollars.
Roughly, yeah. It's a very clear move to, shed those legacy parts of the business, maybe ones that are dragging, and embrace a leaner, more agile model.
That is a monumental move. And it's not just selling off parts either, is it? You mentioned an IPO.
That's right. They're also planning this huge initial public offering, an IPO, for their North American 7-Eleven operations.
So 7-Eleven Inc. basically spinning off a really key part of their business.
Exactly. And the target for that IPO is the second half of fiscal year 2026.
So this isn't just tweaking things around the edges.
Oh, no.
This is like a fundamental restructuring of their whole identity as a company.
It absolutely is. And interestingly, alongside these big structural changes, they're also showing a really strong commitment to returning cash to shareholders.
That's so.
They're planning to return a total of 2 trillion yen. That's roughly 13.2 billion US dollars through share buybacks by fiscal year 2030.
On top of dividends.
On top of maintaining what they call a progressive dividend policy.
Yeah.
So it signals confidence, right? Confidence in this new, streamlined direction and a real dedication to rewarding their investors.
So, okay, what does it mean for you, the listener, when a company this huge, this familiar in retail, makes such a decisive shift?
Well, it's a powerful signal, I think. It shows that even the biggest players are optimizing. They're focusing hard on their most profitable segments, the ones that can scale globally,
Right, they're doubling down on what truly works for them.
and shedding what doesn't. And that kind of move, well, it could really reshape the competitive landscape in retail.
Makes sense. And this whole strategic pivot, it really clicks when you start looking at how their individual business segments are actually performing.
Exactly. The numbers tell the story.
So let's start with the heart of their empire, maybe. Their domestic convenience stores in Japan, that's mainly 7-Eleven Japan Co., Ltd. How did they do last year?
Okay, so in Japan, 7-Eleven Japan saw revenues dip just a little bit, down 1.9%.
Okay.
And operating income fell by more, about 6.8%.
Hmm.
Now, that profit drop, it was largely because their gross profit margin got squeezed.
Costs rising.
Yeah, exactly. Persistent rise in material costs, utility expenses hitting them hard. So even their core Japanese market felt that inflationary squeeze.
Right. So given those pressures, what are they doing? How are they adapting, innovating within Japan?
Well, 7-Eleven Japan is really focused on a few things: refining their core merchandise, making sure they have what people actually want,
Like basics.
basics, but also expanding assortments based on, specific market needs. And they're really pushing their 7NOW delivery service, trying to expand that nationwide.
Delivery's huge everywhere.
It is. And they also launched something kind of intriguing back on February 29th, 2024. It's called the SI Store.
SIP store. What's that?
It's a new concept store. They're testing it currently in Saitama Prefecture. The idea is to pilot innovative services. Maybe advanced self-checkout, maybe more personalized offers.
Trying things out.
Yeah, trying to understand what future customers might need before they roll it out wider. And interestingly, despite that income challenge, their total store sales actually exceeded the previous year's figures.
Really? By how much?
They topped 5.3 trillion yen in total store sales.
Wow, that's still a massive sales figure. It makes you wonder, though, what are customers actually buying?
Yeah.
Especially from these just-made assortments and through 7NOW. Is it the same old stuff?
Well, it reveals something crucial, I think, in this era of inflation and, time-poor
No
consumers.
one's busy.
Right. The modern convenience store is just about grabbing a quick snack anymore. They're top-ranked, just-made, and 7NOW items. They include things like grilled chicken thigh with sauce.
Okay, like a meal component. Yeah.
Exactly. Hot sandwiches, even melon pan, which is a popular sweet bun.
Mm.
And for their own popular 7 premium private label items.
Mm.
Milk, corn dogs, fresh eggs were big sellers.
Everyday stuff.
Yeah. It shows 7 & I is becoming a real go-to for affordable, ready-to-eat meals and daily essentials. It's kind of blurring the lines, between a convenience store and a mini grocery.
So it's about being part of the daily mail solution now?
Definitely. An integral part.
Okay, so from Japan, let's shift our focus across the Pacific. Their massive overseas convenience store operations, especially in North America, run by 7-Eleven, Inc. How are those numbers looking?
Right. So overseas operations, which includes North America, saw revenues jump quite a bit, up 7.7% to over 9.1 trillion yen. Big numbers.
Okay, sounds good.
But operating income dropped pretty sharply, down 28.3% to about 216 billion yen.
So that same pattern again. Revenue up, profit down.
Yeah.
Why there?
Well, it happened in what they described as a pretty tough consumer environment over there, especially impacting lower and middle income folks who are really grappling with inflation and high interest rates.
Makes sense. Consumer spending pressure.
Exactly. So again, revenue growth, yes, but significant pressure on those profit margins.
So how are they tackling these challenges and planning for growth in such a competitive market like North America? What's the strategy?
Well, 7-Eleven in North America is really pushing a few key areas. One is their proprietary products, things you can only get there.
Exclusive stuff.
Right. They're accelerating digital and delivery services, too.
Yeah.
You mentioned delivery earlier. Their 7NOW boasts a pretty impressive national average delivery time, just 28 minutes.
Wow, that's fast.
It is. Speed is key. They're also working on improving operational efficiencies, trying to cut costs internally, and, of course, expanding their store network.
Leaning into speed and convenience as the edge.
That seems to be the play. And they've been pretty aggressive with acquisitions, too, haven't they?
Yes, buying up stores.
Absolutely. They recently acquired parts of Sunoco LP's convenience store and fuel retail business. That added 204 stores to their network.
Okay.
And down in Australia, they acquired a company called Convenience Group Holdings. That group operates 751 7-Eleven branded stores there.
So big moves internationally, too.
Yeah, these are crucial steps for their really ambitious plan. They want to extend their presence to 30 countries and regions by the fiscal year ending December 31st, 2030.
30 countries. Okay, quite the global ambition.
Definitely.
Now let's talk about the segment they're actually getting rid of. Their superstore operations. This includes Ito-Yokado and York-Benimaru. How did this part of the business perform leading up to this big sale?
Right, the part being divested. Well, revenues for the superstore operations decreased by 3.1% last year, and operating income fell pretty hard, down 23%.
Okay, so underperforming compared to convenience.
Generally, yes. Ito-Yokado specifically is going through this major overhaul, lots of store closures. That actually helped their operating income recover slightly from a loss they had the year before, but it's still low.
And York-Benimaru.
Their operating income was also down, about 10.1%, largely blamed on that sharp rise in raw material prices hitting food margins.
Right. This whole shift, though, especially the significant store closures in the superstore segment, it really raises an important question, doesn't it? What does it tell us about the broader trends in retail right now? Streamlining, focusing on core strengths.
Oh, it clearly illustrates that trend. It's a strategic retreat from these maybe less profitable, more traditional retail formats.
Like department stores and large supermarkets.
Exactly. Ito-Yokado, for instance, they launched something called York Deli, the new delicatessen brand. That signals a shift even within their remaining footprint towards high-demand food items.
Focusing on food.
Yeah. But even more striking is the store count. The number of Ito-Yokado stores dropped from 126 back in fiscal 2022 to just 92 this past fiscal year.
Wow, a big drop.
And get this, the number of stores that carried their own self-planned apparel line, it went from 113 down to 0 in that same period.
0, so they're completely out of apparel.
Seems like it. This isn't just, a slight adjustment. It's a very clear move to shed those underperforming assets and really narrow their retail focus to segments with higher potential.
And that mirrors what we see elsewhere, right? General merchandise stores struggling against more specialized players or online competition.
Precisely. It's a tough market for that format.
Okay, and finally, just a quick look at their financial services segment. How did that do?
Financial services. Well, revenues were up slightly, 2.2%, but operating income dipped here too, down 16.1%.
What's driving the business there?
Seven Bank, which is their ATM arm, actually expanded its domestic ATM network. They added almost 600 machines.
More ATMs. Interesting.
Yeah, brings the total to nearly 28,000 in Japan, and the average number of daily transactions per ATM actually increased.
So people are still using cash or at least ATMs?
Apparently so. And they're also doing something interesting with integration. They're linking their 7ID loyalty program with 7 bank accounts.
Ah, connecting the data.
Exactly. Pushing for better data utilization across the whole group. Try and build that synergy, boost customer engagement within their ecosystem.
Makes sense. Okay, let's pull back the curtain a bit now. Look under the hood at costs and also their sustainability efforts. Their overall SG&A expenses. Selling, general, and administrative, they increased, right?
It did, yeah. Overall, SG&A went up.
So what's driving those changes in the background? What are the main cost pressures?
Well, it's a bit of a mixed bag, but the increases definitely outweighed the savings. They saw some minor savings in things like advertising spend and maybe some salary adjustments based on performance incentives.
Okay, small savings.
But those were largely overshadowed by increases elsewhere. Land and building rent went up. You can thank inflation for that.
Right.
Depreciation rose because they made new investments in store-related assets. Utility expenses jumped because, well, energy rates went up.
That hit everyone.
Pretty much.
Yeah.
And perhaps the most notable jump was in what they categorize as other expenses.
What's in there?
Primarily driven by repair and maintenance costs for stores, and also substantial investments in system upgrades and ongoing IT maintenance.
So keeping things running and modernizing costs money.
A lot of money, apparently. So yeah, while they maybe trimmed some fat in a couple of areas, those essential operational costs and just general inflation really impacted them heavily.
Got it. And beyond just the everyday running costs, they also took some big hits, right? Substantial one-off losses this fiscal year.
Yeah.
How much are we talking?
Over 220 billion yen in total special losses. It's a big number.
What were the main drivers there?
Well, a major factor was a really significant impairment loss, 98 billion yen. That's almost double what it was the previous year.
Impairment on what?
A big chunk of that, about 56.7 billion yen, or roughly 375 million US dollars, was specifically booked for closing unprofitable stores in their international operations, so likely North America.
Ah, the cost of restructuring overseas.
Exactly. Then there were also losses, over 46 billion yen, related to restructuring their last-mile delivery strategy, maybe consolidating or changing how they do delivery.
Okay.
And another 25.6 billion yen in general restructuring expenses, including costs from things like system integrations, maybe related to the York Holdings part of the business before the divestment.
So these are really the heavy upfront costs associated with making those big strategic shifts and slimming down the company.
That's exactly what they look like, the price of transformation.
And, amidst all this financial maneuvering and restructuring, how does their sustainable management, their ESG focus, fit into the picture? Is it taking a back seat?
Well, it's interesting. While all these massive financial shifts are happening, it is worth noting they have this Green Challenge 2050 environmental declaration. They announced it back in 2019.
Right, I remember that.
And, this isn't just PR fluff anymore. Increasingly, investors, consumers, they scrutinize these ESG commitments. So this declaration, it sets some pretty ambitious targets for 2050, focusing on big things like reducing CO2 emissions, tackling plastic waste, cutting down on food waste, and ensuring sustainable sourcing for their products.
The big ESG pillars.
Right. And they've also formally put out a nature policy and a human rights policy. So the framework is there.
The interesting question, though, is how do these ambitious targets actually factor into their operational efficiency and their long-term costs, especially now as they're streamlining the whole business?
That's the key question. Are these primarily an investment in future brand value, building goodwill? Or do they also potentially drive immediate operational efficiencies, maybe through waste reduction or energy savings?
Could be both, I suppose. But it's something to watch as they reshape the company.
Definitely.
Right.
How ESG integrates with this leaner, more focused strategy will be telling.
Okay, so to kind of wrap things up here, recap a bit. We've seen how Seven & I Holdings is really navigating this incredibly dynamic global retail landscape.
Yeah, it's moving fast.
They're clearly sharpening their focus, betting big on their core convenience store business, and they're doing that through these major strategic divestments like selling the superstores.
Significant acquisitions, especially in places like North America and Australia, bolstering that core.
And these massive plans, like the potential IPO for their North American operations.
Right. It really isn't just about shuffling the financial numbers around.
No, it feels much bigger, like a complete reimagining of their operational footprint, what they are as a company.
So what does it all really mean then, when you put it all together?
Well, for a company like Seven & I Holdings, these feel like far more than just business adjustments.
Agreed.
They represent a really fundamental strategic realignment. It signals a future that's heavily, heavily invested in global convenience and also digital innovation.
The clear aim seems to be creating a leaner, ultimately more profitable company by concentrating laser-like on its strongest assets.
And shedding those businesses or assets that no longer fit this bold new vision.
Getting focused.
Exactly. So as you, our listener, consider all this, maybe think about how these massive strategic shifts, like selling off huge historical parts of a business or pushing for an IPO of a major subsidiary, how they don't just impact a company's stock price or bottom line.
Right, the ripples go further.
They ripple out through the whole competitive landscape of an entire industry. They actually change what convenience truly means for you, the consumer, worldwide.
That's a great point.
Perhaps, sometime soon your local 7-Eleven might feel less like just a quick stop for a Slurpee or a pack of gum.
And maybe more like a really pivotal part of your daily meal plan or your go-to for quick essentials delivered in minutes. The definition is evolving.